Okay, welcome to episode 6 on the put path. We're going to go over how to choose your lot quantity. Okay, so this is a very important question. You got to try to control your size. So there's a lot of things that you need to think about when you're talking about the size of your lot. So what we try to do is trade all 12 underlyings. So you need to preserve capital to evenly distribute across all 12. This is important because you could have a situation where you could trade a 12 lot of QQQ, or you could trade a one lot of all 12 of these underlyings. The way that we trade is we distribute that risk across all 12 underlyings. And then that way, if one or two for that week happen to be a loser, then we've got 10 or 11 that are winners. So it's the concept of diversification. And it helps you in the long run because you don't have all of your eggs in one basket, like a QQQ, for example. So again, the contention is don't scale up in only one underlying. You want to spread your risk around to multiple underlyings. So how do we do this? And what is your capital allocation? So a lot of people have an options trading account or brokerage account that they use a portion of their money for options trading. I definitely would concur with that approach. For me personally, I have long-term savings, 401k money separate from my short-term savings in a brokerage account, and then also in an IRA account. These are separate accounts. So in my mind, these are options trading accounts exclusively. For me, I am 100% invested in options trading in those accounts. Now, again, this is a personal choice. How much money do you want to allocate to your options trading? I definitely would caution you against risking more than you can potentially lose. Do not ever risk money that you're not willing to lose. Same rule as when you gamble. So, you know, the more percentage of that account that you risk, the more that you can make as well. So you've got to risk it in order to be profitable in these options. The phrase is you got to risk it to make the biscuit. So, it's a personal choice. For me, I use that predefined capital limit in these separate accounts, and I am 100% invested in those accounts. So let's take an example. When I was using the account size of between 36 and 40,000, trading in that Robinhood options account, if you are using a $5 wide credit spread, which is what we do, a $1 option across 500 shares means 500 wide on your put credit spread. So let's take an example and show you what that means. So here's Robinhood account. You can see the buying power is 2,197. So if we scroll down to make an example trade, let's say of QQQ, let's do a standard trade. So we're going to go out 28 days. Again, this is just an example. We're going to sell the put. We're going to go down to chance of profit, 85. Let's go to the 560 here. We're going to buy the put, $5 below that for protection. You hit continue. So for a one lot, we'll leave it at 1. We'll leave it at 54 cents. Hit review. So again, where are we? We're a one lot, we're 54 cents. We're going to get a credit of 53.92 after they take out the fees. The collateral, that is what to focus on for this episode. Collateral means the buying power reduction. So when we're selling the 560 and we're buying that 555, it's a $5 wide, and that equates to 500 in your buying power reduction. Hopefully that makes sense. So as you scale up from there, we're not going to execute this trade. We're going to go back to the Put Paradise, Put Path, episode 6. All right, so hopefully that example made sense. So let's look at the bigger picture. So when you're talking about 12 underlyings and you're talking about $500 in buying power reduction per trade, the math works out like this. You need $6,000 per week. That's actually a little bit more like 5,600 because the credit that you get back does not come out of your buying power reduction. So since we're getting right around 40 cents a trade in that area, $40, the way it works out, roughly 5,600 is actually the buying power reduction that week. But let's, for conservative reasons, just keep the math simple. Let's say it's $6,000 per week. Now, again, we're working this over a 4-week period. So you're going to need 4 weeks times 12 underlyings times $500 per lot. We're using the one lots. So you're going to need about $24,000 in available buying power reduction or available capital. From there, you can scale up to 2 lots. If you get up to 48,000, scale up to 2 lots. If you have 240,000, you can potentially go to 10 lots. So that gives you a rough idea. 72,000 would be a 3 lot. In order to get the maximum value out of this system, I recommend that you have 24,000, which is going to allow you to trade in one lot across all 12 underlyings using the ladder structure that we have set up. So that's the minimum to be fully effective. Now, if you only have $2,000, that's okay too. You can trade one name, QQQ, and then as you get more capital, let's say you get 4,000, now you can also trade SPY, and then you can kind of scale up from there. The system is very flexible, very scalable. There's no limit to how uh, how you can go in your lot size if you so desire. If you have a market that's liquid enough, you're going to be able to trade in these larger lot sizes. Now, as you do scale up, we want to move away from QQQ and SPY and IWM. We'll probably move into the bigger names. If you're trading over 10 lots in, SPX, you want to switch to SPX. So if you're trading 10 lots of SPY, you want to switch over to SPX. Same goes for QQQ. If you're trading 10 lots of QQQ, it's more advantageous to switch over to start trading NDX. Same with IWM. If you're trading 10 lots of IWM, you want to switch over to trading RUT. We'll talk about that more in more detail in a future episode. But to wrap up today, what we want to focus on is making your capital efficient for you, depending on your risk level. If you're okay with going all in and putting your capital to work in these options accounts, then you want to be 100% invested in that account. That's going to allow you to have larger lot sizes and potentially larger winners. Now, again, the downside of that is you could potentially lose more as well. But because we have that diversification across the 12 underlyings, the risk is much lower that you're going to lose all 12. So hopefully that makes sense. And we'll see you back here for a future episode 7 along the put path.